Good morning, everybody. Usual format. Today we've got to have me and Richard actually running through the news this morning, and then our guest this morning is the manager of Biopharma Credit, which is one of the bigger funds that you may not know very well, and I think that's going to be quite an interesting listen. So as usual, if you want to ask questions as we go, just email me on jc@markmanco.com, or alternatively put them in the Q&A function here, and I'll get to them as soon as we can. So the things I wanted to pick out on the news front, from my side, triple point energy efficiency and Trian 1, both of which there are many shareholder revolts going on. And the other one is urban logistics, which had some very good results, which Bruce is going to tell you about. So triple point energy efficiency first. We've talked about this a couple of times already, so I won't dwell on it too much to the history. But basically, the main problem was that it was quite slow to get money invested. And because of that, and because it committed to paying quite a high dividend from the off, it's been distributing capital, and that's been obviously depressing its NAV. So it's not very big, only about £90 million in terms of market cap. And it's on a 7% discount now to the NAV that they just recently announced. So that's going to make it quite hard for it to grow. There's the share price and the NAV chart since it started. And you can see it was on a big premium for a long time and is now moved out to a discount. I think it's going to be hard to pull that back. It's really going to come back to, once they've got the thing invested with it and demonstrating that it is covering its dividends, will people then like it? So this is what's invested in. Again, you've seen most of these things before. The one new thing on this list here that you haven't seen before is £1 million investment in a lighting solution provider to fund the installation of efficient lighting. That, to my mind, is the only project in here that can be classified as energy efficiency. And this was, I think, one of the problems, that it never really managed to fulfill what its initial brief was. So the NAV is, at the end of March, is 96.1. It would have been lower than that, but they wrote up the value of their hydropower assets, and that's on the back of inflation. So there's nothing sort of dodgy going on there. That's a genuine uplift. The dividend, they are maintaining a 5.3 target rate, but they only cover that with revenue 1.26p, and in terms of cash dividend cover, it was only 0.14 times. So that's eating into the amount it's got to invest. It has invested about 80 million quid now, and once they've invested everything that they promised to do, so basically the main difference is the battery projects that they promised to do, then it will be fully deployed in terms of the IPO proceeds, and it will have drawn down some of this new credit facility, which is paying 4.5% a year for, which I think is probably about right. It's interesting that the credit's coming from an affiliate of the investment manager. I think it is quite hard for these things to get bank credit until the bank's comfortable with the underlying portfolio. And it is a sort of mishmash of things, which made it a bit harder, but obviously having somebody who understands the projects is going to make it a bit easier. The one thing that I've been worried about for a while was that they had a big exposure to this outfit called APS Salads, which is a big tomato grower in particular across the country, and they've been struggling because a lot of their greenhouses are heated with natural gas, and obviously the prices go shooting up, and that inputs into has an impact onto their cash flow. Nevertheless, it sounds as though it's okay. So we'll wait and see, but it does sound as though it's sort of had a difficult year, but it's going to be okay. So the reason why we're talking about it, they've announced sort of a consultation on a proposal to change the investment policy. So really what we're doing is just putting a rubber stamp on what they've been doing all along, which is rather than investing in energy efficiency projects, we're investing in basically energy transition type things. So that would require a change to the investment remit, and also they're going to change the name to Triple Point Energy Transition Intent. They are going to widen the geographic remit. I can't really see a logic for that, unless they are really struggling to find things to invest in, which I'd be a bit worried about. There are a couple of other bits that aren't very well explained in there, and I think we'll have to wait for a circular to see what that means. So clarification of structures used to make investments. I suppose it's just going to come to sort of legalistic wording of the remit, and defining what adjusted gross asset value is in terms of disclosure limits. And again, we'll have to wait and see what that actually means. I think they probably will, both of them, be sort of kind of minor issues, but you never know. There'll be a vote on this at the August AGM, so shareholders need to approve it all. I do think, though, that shareholders need to think about, when they're being consulted, do you really want this to carry on as an independent company? Of the two, between it and the Equilla vehicle, I think this is slightly more established and actually has a better chance of putting itself together. But it still needs to win over investors and get their confidence to get that discount eliminated and be able to grow. And I think to do that, it needs to demonstrate you can cover the dividend, because obviously we're a long way off that at the moment. So the jury might still be out for a while. We'll just have to wait and see what happens in August. Trian is a vehicle for Nelson Peltz's Trian Partners in the UK. It was set up, and the fact that it's called Trian Investors One kind of makes it obvious, that it was set up as the first of a series of vehicles that would invest in individual stocks. Trian decided to have a go at. And the idea was in the prospectus that once the investment was realised, the proceeds would be handed back to investors and the thing would be wound up, in theory. And therefore, if you've got a situation where you know you're making an investment, it's going to poodle along while the Nelson tries to aggravate for change, and then once that's been achieved, you're going to get your money back. It doesn't really matter what happens to the discount in the intervening period. The stock that they chose to target was Ferguson, which is the plumbing business. And one of the arguments was that it wasn't properly valued by UK investors and it would do better if it was listed in New York. And that's actually going to happen in May. So I think we're getting near to the end of the story for that investment. And it's been quite a good investment in terms of the return it's generated over that period. So all well and good. There is the NAV going on the back of this, all great. Pulled back recently along with the markets, fair enough to expect. But it did disconnect in terms of discount around here, and that's just got wider and wider and wider. And that, as I said, it wouldn't matter if the next intention was sell the Ferguson stake, hand the money back, but that isn't the situation now. So in May 2021, it said we're going to change our investment policy and invest in other companies and do things with the vehicle, like possibly take control of companies, or all sorts of different things that weren't intended with the original vehicle. To sweeten the deal, they offered $30 million of share purchases, some buybacks and some investment by the manager. And they put that to shareholders. But it only just passed, and it definitely would not have passed had the managers holding and that of the broker and their mates not been voted in favour of it. So actually the independent shareholder vote was very much anti this whole idea. And not surprisingly, the board felt they had to address that. And so that's the board's statement on the issue there. And it leans quite heavily on the idea that they were going to try and do something about the discount as a way of allowing people, I suppose, to get out if they didn't really want to progress this. But as we can see from the previous chart, it didn't really happen. And then in March, April this year, it got a new credit facility and invested all its spare cash in that into a stake in Unilever. And now Trian has a big stake in Unilever. Well, it's 1.5% of Unilever, big enough to persuade them to allow Nelson Peltz to go on the board of it. So that's happened, and actually they've probably made money on it. So if they think they were buying around here and it's about here now, that probably is making money. So again, reasonable investment. But the Dissenting shareholders are still not happy. So what they're proposing is to change the board. So get rid of 3 of the 4 directors and put 2 new ones on. And the requisitionists hold, and their supporting shareholder Aegon hold about 44% of the company between them. So that's probably enough to force quite a close vote on that. It's going to depend on who votes. And if the thing is defeated by virtue of the manager's stake, there's always going to be this question mark about really, have you just trapped investors in there against their will, which is not a good look, I think, for Trian. There's a slightly sort of funny situation in that 2 of those requisitionists are investigating Janice Henderson, and Nelson Peltz has actually gone on the board of both of them recently with the idea of shaking them up. So there might be a bit of knockback against that. I think the other thing that they highlighted that I think is really quite relevant here is that the way that the performance fees are structured, although the performance fee hasn't been paid out yet because the funding hasn't been realised, there's a really chunky amount of fees going to the manager there. So basically half the return is going to shareholders and half the return is going to the manager. And I think that's probably a bit too much, really. And that maybe needs to be addressed if the thing is going to win shareholders back again. But I wouldn't be surprised if they start actually win the requisition, and we'll see what happens next. So that's that from me. Let's quickly hand over to Richard. He's going to talk about urban logistics.
Hi, thanks. Yeah, so as James said, Urban Logistics brought out annual results this week, and they were really good. Yeah, so in their words, it was a transformational year, and it really was for them. So they raised 358 million during the year in 2 equity raises. It moved to the main market from AIM, and a few weeks back was included in the FTSE 250 index. So here's the result summary, which make for good reading. So NAV was up almost 24% to 188.8p, and NAV total return about 29%. And since its launch about 6 years ago, it's averaging 16.4% NAV total return per year, which is pretty decent. But it's almost doubled in size in this year. So it's, on a like-for-like basis, its portfolio is up 25%, but including acquisitions from those 2 capital raises, its portfolio grown to over 1 billion, almost doubling in the size. And as you see there, all other metrics up. Its earnings doesn't at the moment cover their dividend, but that's due to the capital raises last year, and it's had some the year before that as well. It's got very low loan to value of 11%, and they're looking to bring that up to 30% with utilising their undrawn facilities. So that's about another 200 million of equity to spend on new acquisitions. On the next slide, we see its performance since it launched. This hasn't actually been updated by Morningstar to reflect its new NAV. So its new NAV is 188 or 189. So we can see that it's actually, and the share price hasn't really moved. So it's actually trading on a discount of about 12% at the moment off of that new NAV. Yield's pretty good. Probably scope maybe in a year or 2 to increase their dividend once they've sort of fully invested. But you see that tail off in the last few weeks of the share price, and that's hit quite a few of the UK logistics companies. It was from basically from an Amazon earnings update where they said that they were going to stop or halt their growth in acquiring logistics centres. That was mainly focused on the US, but a lot of the UK and European logistics funds have been hit by that. Investors sort of spooked by that a bit. So we see a tail off there. But if we go on to the next slide, we see why I think this shouldn't really be impacting urban logistics like it would others. So on the left chart there, they're asset management intensive. So the main focus is to buy short let logistics facilities in urban locations, so close to main cities and towns, and release that on higher rents basically, and then drive through value that way. So we see on the left bar chart, this is over the year since existence. In the black is value that's been created through their asset management, and the sort of turquoise colour through market movements. And obviously last year was massive for logistics, and they had much more yield compression through the capital market side basically. But over the course of they've been there, that averages out about 71% of their valuation uplifts is through their own sort of asset management initiatives, which is quite big. And I would say, without looking at all the other competitors, is probably peer leading. So they're really focused on the asset management side, and that's as we move on to this year, with the situation we're in, you're not going to get 25% like-for-like uplift again in the portfolio, and that 45% of that coming from the market. So it is the asset management side of things that's going to be driving value, and that's what puts them above their peers in my eyes. On the right is that's their portfolio. So they've got core assets, which are longer let stuff, and then 51% of it is active asset management. So they're the shorter let stuff that they've got plans to relet basically on longer leases, which will then go into their core portfolio, and then a small bit on development, which they're saying they're getting sort of 6% yield on cost on that, which is way above the sort of sub 4% yield in the market. So pretty good shape going into these uncertain times to capture more value. So on the next slide we have a sort of outlook, and so they've still got some equity to spend from their capital raise, which they made in December, and they expect to fully deploy that by September. And as I mentioned earlier, they've got a very low LTV, but because they've not drawn on some of their facilities, so they're looking to place that as well in new acquisitions, and they reckon about 210 million that gives them. That will take their LTV up to 30%, which is still pretty good and conservative. So they've got a lot more growth to come on the portfolio side there. And then on the market in general, we've got a sub 3% vacancy rate. I mean, that's what we need to be looking at, rather than the Amazon side and the demand side is still there. But if you sub 3% across the whole of the UK in logistics is unbelievable, and there's just literally no space, and that will come down. That includes secondary space. So if you take prime space, that's going to be even less. So occupiers are falling over themselves for this space still. And if we take, there is a stat, so the first quarter of this year was a record take up in the UK, and Amazon only accounted for 3% of that. So it shows the market is more than Amazon, although they have been a big player. And then they say there's 22% reversionary potential in their income. So that's moving on the rents basically. They've got the potential to move them on 22%. And then this coming year alone, 13% of their income is due for rent reviews, and the majority of that is open market. So you can imagine that's going to push on quite a lot. And 9% are due to expire this year. So again, with the occupational market as it is, you can see them bringing either renegotiating the lease with the existing tenant, or bringing a new one in on much higher rent. So there's a lot of potential for growth this year. I don't think it's going to be the same as the results that they did last year, but I can see it being market leading against their peer group, just because of the fact that they're so on the asset management side of things, which is going to become a lot more important as we go into this period of uncertainty.
Great, thank you, Richard.